Welcome to Trading Nation. I'm Mike Santoli. Stocks in rally mode following Fed Chief Jerome Powell's latest comments. Powell suggesting fewer rate hikes may be ahead over the next 13 months. Joining us with some reaction, David Rosenberg of Gluskin Sheff, who's been bearish on stocks and mindful of some perhaps weaknesses in the economy. Dave, good to talk to you on a day like this. I wonder what specifically you heard today from Jay Powell, whether it represented to you any kind of acknowledgement of a changed environment, or was it more of the same?
Well, I think that if you had this view that, that Powell had a hawkish policy bent, I think he removed that today. He walked back some of the, hawkish rhetoric back on October the 3rd. I think that this is, look, the market really wanted to rally all day anyway, and I think a lot of this is because of a lot of hope over the coming G20 summit on the weekend and hopes over a diffusion of this trade war with the U.S. and China. But it's curious in terms of, if you're going to boil the rally this afternoon off Powell alone, I'm a little circumspect because he didn't really spin the dial that much. The one thing that caught my eye was that everybody talks about that, he switched to say that we're just below neutral instead of saying we're a long way from neutral. But what was really key on October the 3rd that nobody has picked up on, but I think that Donald Trump did immediately thereafter, was his comment that the Fed was probably going to have to go above neutral. And he didn't walk that back. And wherever you think neutral is, and it's a little bit higher than it is today, he didn't walk back the comment October 3rd that he's going to have to probably go above neutral, which is no surprise to me because there's never been a Fed tightening cycle at any time where the Fed didn't go above that fabled neutral level. So it hasn't changed my opinion of where Fed policy is going to be going over the next year, which is probably a little tighter than what's priced in right now.
All right, so if you think the Fed perhaps is going to have to, or is going to get a little tighter than what's priced in, is that going to be too tight for the real economy?
Well, I think that there's a risk that it will be. And Michael, the other part of this equation, and this is the elephant in the room, that again, nobody's talking about. Nobody's talking about that he did say they'd have to go above neutral, but nobody's talking about the balance sheet. There was nothing in the speech today about the balance sheet. The balance sheet reduction this year was the equivalent of 100 basis points of tightening via the funds rate. And if the Fed does what they say they're going to do, which hasn't come up, which is $600 billion of quantitative tightening in 2019, that's an additional 130 basis points of tightening. And so the Fed doesn't have to really do anything on rates. Just the balance sheet alone is going to create quite a significant liquidity squeeze next year. And it's uncertain as to whether that causes an outright recession, but it certainly is going to trigger, I think, a significant slowdown that we're already starting to see in a lot of the credit-sensitive data, including new home sales, which in the past 3 months have cratered by more than a 30% annual rate. And as Powell had said, and I thought was very important, was that there's lags between what the Fed does on time A and the peak impact it has in the economy in PQR. And we're going to be seeing, with no fiscal stimulus next year, the peak impact of Fed tightening, the lagged impact, hit the economy and the markets more forcefully in 2019. I think that'll be a major theme.
Yeah, we'll have to wait and see how that develops. I think I'm with you on the idea that the market was looking for an excuse to rally today anyway. We'll see if it carries ahead from here. Dave, we have to leave it there. Appreciate your time today. Thank you very much. And thank you for watching Trading Nation. I'm Mike Santoli. We'll see you next time.